you in an on-demand link via an email. So once again, thank you everyone for joining. I am honored and privileged to welcome our guest today, one of the most innovative ETF issuers that we're privileged to do business with at Cboe. Allow me to introduce you to Cathie Wood, CIO and CEO of ARK Invest, Jan Van Eck, who is CEO of Van Eck, and of course, Kevin O'Leary, chairman of O-Shares and well-known for Shark Tank. So thank you everyone for joining. Let's just dive right into the questions that I've prepared for you. This is a really exciting time in the ETF industry, no doubt, with the growth from all aspects, despite all the hurdles we've had to overcome given the pandemic. But looking back, I mean, essentially, Jan, of all of us, you were the first to enter into the ETF industry back in 2006, I believe, and now you have 58 ETFs. Cathie, you joined in 2014 and have 7 ETFs, and Kevin, you joined in 2015 with 4 ETFs, which we proudly accepted as a transfer over to the Cboe platform just at the end of last year. So welcome. Each one of your partnerships are essential to us and super important. What I'd like to ask you is, given the growth and your assets that you've raised, what is next for 2021? Jan, we'll start with you.
Sure. Good morning, everyone. It's great to see you. I think one of the biggest things that's happening is the macro horizon, where we're seeing a paradigm change, I think, in I'll call it the environment of the financial markets. So since the global financial crisis, basically monetary policy, the central bank was supporting the financial markets with a whole bunch of stimulus measures. What we've seen over the last year, though, is I think with the fiscal spending happening, GDP growth is expected to be in the 6, 7, 8, 9, even 9% growth range in the United States this year. Those are numbers that we haven't seen since the 1950s. And what I think will have a direct impact is driving interest rates up at the 10-year interest rates. And so in November, we said those rates will go up. Right now, they were 80 basis points. Then we said it would go up between 1.5% and 2%. That happened in 3 short months. And we think that now there's a risk in the second half of the year with this tremendous stimulus that interest rates go higher. That will cause some turbulence in the financial markets. I think it's okay for equities, but fixed income, I think, will be challenged. And so you really have a new dynamic coming into play, we think, now compared to the last 10 years.
You can't agree with you more. Kevin, what are your thoughts?
I think this will be a year of, and I agree with the issue around fixed income. I've made a change to my own holdings and that of my family trust from 50-50 fixed income equities to favor equities for the next 2 years, 70% equities, 30% fixed income. We distribute 6%. So really what I'm trying to do is preserve wealth during what I think is going to be a really interesting time. On the upside, I agree with the forecast of 7, 8, 9% GDP growth. I'm seeing that in my own private portfolios. Remarkable recovery occurring here, and it's buoyed by basically a $1.9 trillion of free money. I mean, that's really extraordinary, and it's going to have some inflationary outcomes. I don't know where and when, but also at the end of the day, trying to preserve wealth means figuring out what asset class to own in what could be inflationary times. And fixed income does not become competition for equities until it gets a 3 handle on it on the 10-year. And I think we're well aware from that. So I want to own companies that have pricing power in inflationary times, that are profitable, have high return on assets. It's kind of boring. It's not as rock and roll as it's been for the last year coming through the pandemic. I think now people seeking quality, profitability, sustainable return on assets as we try and figure out what this economy looks like post-pandemic. There are some sectors that are permanently damaged because of consumer behavioral changes, and I'd argue airlines are one of them. I'm not planning on flying as much. My companies have slashed their budgets 20 to 50% on business travel and entertainment. And I know everybody wants it to be the way it was, but technology has replaced it. I don't need to fly to Dubai anymore. We're doing Zoom calls every week. So that I will go, but it'll be far less frequently. And that's very profitable for airlines. As an example, when you fly everybody to Orlando for $89, that's a crappy business. And I expect that'll show up eventually in price earnings valuations for sectors like that.
Cathie, what's in store for your 2021?
Well, we're all focusing on the same variables, right? First, interest rates. A lot of observers, analysts, strategists worry that this rise in interest rates is going to hurt strategies like ARCs. And certainly that has been the case in this risk-off period or this rotational period in the market. We do not believe that 0.5, 1, 1.5, or 2% interest rates were ever discounted in the market as being permanent. We believe the market has been pricing stocks on more of a normalized, say, 3 to 4 to 5% interest rate longer term. The reason I say that is I've been marveling since 2000, the tech and telecom bust, that every time the S&P 500 multiple got into the 20 to 25 range, the market topped out, despite the fact that interest rates were falling from that 6% to ultimately what we saw last year's 0.5%. Now, I think a key question for us, though, is how far will interest rates go up? And that involves fears around inflation. There are a lot of supply chain issues that we're seeing right now moving into pricing statistics. And we know the base effect last year, the oil price in the futures market going negative was quite unusual. And so now the rebound to roughly $60 per barrel is going to show through as other commodity prices rebound. They're going to show through in all of the price indices. So we might see 3 to 4% on some of the indices, CPI, PPI. But the question is that going to be sustained? We believe we're in a nice cyclical bounce right now, but we think there are two powerful deflationary forces at work in the global economy. One is good, one is bad. The good deflation is associated with innovation. And we're seeing some massive deflationary forces. Just looking at DNA sequencing, 40% cost declines for every cumulative doubling in the number of sequences. Industrial robots, 28% cost declines for every cumulative doubling in the number of industrial robots. Battery pack systems, likewise, 28%. So powerful deflationary forces. That's good deflation. It's going to stimulate a lot of demand going forward, adding to the cyclical momentum out there and being sustained far beyond the cyclical moves. The bad deflation is coming from companies, and this will intensify, we believe, over time, who spent the last 20 years catering to short-term oriented shareholders who were demanding profits and profits now. So what they did, and some people call this financial engineering, they leveraged up to buy back their shares, pay dividends. They did not invest enough in innovation, and the innovation explosion we are seeing now is going to put them in harm's way. That being the case, in order to service their debt, they will have to cut prices to clear inventory of what will be potentially obsolete products. So that's bad deflation. So we actually think that deflationary forces, once we get through this base effect, inflation rising for 3 to 4% for several months, maybe even up to 5-6 months. Once that is done, and I think this is the critical question we have to answer, will inflation continue or will it revert? We think it will revert. And then finally, on the markets themselves, in this period, as interest rates have been rising rapidly, we have seen high valuation stocks hit hard. In our view, longer run, the growth rates from these companies are going to be scarce out there. The growth that we're seeing in these innovative companies, these exponential growth trajectories, we think will be treated very well over time. Nonetheless, what we're seeing right now is a rotation from our strategies, our innovation-based strategies, into more cyclical strategies, more value strategies. And we think that's a good thing. This happened at the end of 2016 when President Trump was elected against all expectations. The stock market took off, value took off, and we were negative because many investors understood that cyclical earnings growth would give our earnings growth a run for the money over the short term. That did happen. But that broadening out of the market actually was a very good launching pad for the next leg of our performance. 2017 was a fantastic year. So we like the fact that the bull market has broadened out, that it didn't continue to narrow into our kinds of strategies. We believe the market, therefore, is on a stronger foundation, the bull market is, and that it will serve as a launching pad for our strategies once the cyclical burst has been incorporated into stocks.
Thank you, Cathie, Kevin, Jan. There's a lot there. I think we agree on much of it, maybe not on everything, but I definitely, we had thought like the worst fear that investors had was, in the past, it was the pandemic, it was COVID, but we're definitely seeing a shift now. We're seeing a shift to inflation, like you've mentioned, becoming the biggest tail risk today. And, how do we hedge against that in terms of utilizing the ETFs that we have, that we offer now, and that we're going to launch in the balance of 2021. So taking it down to just maybe talking about more specific asset classes, many are interested in hearing your views of today relative to the crypto environment. Jan, you and I filed a 19B4 which is a filing that's made with the SEC to request approval to launch a VanEck Bitcoin ETF on Cboe. We did that on just a couple of weeks ago on March 1st. And we're excited to take, if you will, the lead on that, having been the first filing that's gone in from any exchange. There's a lot of interest from a variety of other sponsors as well that I think will come behind it. And frankly, what I said 5 years ago, it's not a matter of if, it's a matter of when. I didn't expect it to be 5 years later, and I'd still be saying that, but I do believe that to be the case. Jan, maybe you can just share your perspective on what has changed since then in the past 5 years in the crypto space.
Sure. Well, I think you see two things happening. One is obviously the increasing adoption of Bitcoin. So it's great to see Fidelity at the party. Cathie, I think, was maybe the first at the party using a mutual fund, or an ETF, to give her credit. But what I've been trying to emphasize to people who are not close watchers of the crypto space, and why I think crypto Wall Street is an incredible disruptive threat to traditional banks and financial institutions, is that number one, you can actually earn interest on Bitcoin now, and there are many institutions, I should say, crypto firms that offer that, and I think that will suck capital into the ecosystem. And then the second thing is that the ability to offer financial product has really been established. So you need kind of two things. You need software that can encapsulate the logic, and you need reliable data sources. And both of those now exist in the crypto system, if you will. And so it's not just Ethereum, there are a variety of different protocols and solutions. And so I think, what I say is the biggest symbolic thing that's happening, and it's not really the best example, but when Coinbase goes public, hopefully in the next couple of weeks, you'll see that its market cap will be higher than that of the NASDAQ stock exchange. And that just shows to me the leapfrogging that's happening. So, that's what I think is exciting. Hopefully, the regulators will come on board. In my career.
Yeah. Well, many have said that that's what's missing is the regulation that needs that will support this and bring confidence to the marketplace. But Jan, you mentioned something, and I stand to be corrected because it's true, Cathie. You provided exposure to the crypto world, to Bitcoin in particular, in your offering a couple of years ago. Maybe you can share just your perspective on what you were thinking then and now. What might that change? Might that adjust?
Yes, actually, we gained, or our clients gained, their first exposure to Bitcoin in 2015 when it was about $250. We could gain exposure only one way, and it was through GBTC. We were able to put that security into our ETFs, and we've held. Where we could, I can talk about how ETFs and 40 Act funds treated GBTC, but I think the important point about Bitcoin is back then it was only a $6 billion market cap. It has scaled in the last 5-6 years to nearly $1 trillion in market cap. Back then, therefore, there was really not the liquidity for an ETF. We are now moving into what I believe will be prime time. And I think helping it along is the demand from institutional investors. We've done a study, it's on our website, ARC-Invest, Yassine El-Mandra, about institutional participation in this space. I think we did a million Monte Carlo simulations and came up with if institutions use that kind of analysis where they maybe want to minimize the volatility, or on the other extreme, maximize the Sharpe ratio, they probably should put something between 2.5% and 6.5% of Bitcoin in their portfolios. And the reason is the correlation of returns to other asset classes is extremely low. In fact, according to our analysis, the highest correlation is to real estate, 0.34. And so it's what every asset allocator seeks, non-correlated assets. And we do believe this is the first new asset class, truly new asset class since the 1600s, since equities. So we're pretty excited about it. I think the most surprising development recently, and we didn't expect it when we wrote our institutional report, is that companies are now diversifying their cash with Bitcoin. We've seen Square do this, Tesla do it, MicroStrategy's it's defining its business around it now. And one of the reasons, as Tesla announced yesterday, is it would like to do business in Bitcoin in regions of the world, well, anywhere, but especially regions of the world where the conversion from fiat, from one fiat to another, is prohibitively expensive. So that's been a surprise to us. And if we add all of the potential demand relative to the limited supply, we come up with incredible numbers over the long term. We have just begun. $1 trillion is nothing compared to where this ultimately will be.
It's a strong statement, and I find it fascinating. To buy my next Tesla with Bitcoin would be quite fun and interesting in terms of making that type of transaction. I remember well over a year ago, I was at the New York Boat Show, and Buster's Marine had put up a big sign, "We accept Bitcoin for our boats." I'm not sure how many boats they sold with Bitcoin, but I wonder what those Bitcoin holders are thinking today now, over a year later. Maybe they should have held on to it.
I just want to add one thing there. The IRS has something to say about this. So if you have huge gains in your Bitcoin, I don't think I would be very much in the way of transactions until we get maybe some changes on the tax front.
Yeah, very good point. Very good point. I also just wanted to mention too, let me turn it over to Kevin. Kevin, you recently took back the fact that you felt, this asset class was garbage. And, many people resonated, that certainly resonated with many people. And in your comments earlier, just in your introductory comments, you mentioned, rebalancing your family's portfolio. Tell us why you shifted gears.
Well, I live in obviously, as my cohorts do here, in a highly regulated environment. O-Shares has a mandate for quality and preservation. It's used in many family trusts and pensions and institutions that are looking for a way of protecting downside. And so I take a lot of direction from their guidance on the kind of indexes we look to develop in the future. And Bitcoin was not one of them for one singular reason, that regulators globally were not on board. Now, when facts change, I change, and facts have changed. Regulators in Switzerland and France and Australia, New Zealand, Canada have all decided to take a more relaxed stance and view this as a potential new asset class. And so the question is now for most institutions, how do you want to participate? In what way? Do you want to have a situation where you're allocating a certain percentage or not? So that's the binary decision. Yes or no, in or out. That's number one. Number two is a new problem that I think a lot of people haven't considered, and that is this coin compliant with committees? And the real issue there is around compliance on sustainability and compliance around other issues, such as, is this coin manufactured in countries that are abusing human rights or have sanctions against them? And I'm really speaking now of China. I've had many institutions tell me they do not want to own China coin. And as a result, that's going to be a problem going forward, because the majority of coin is mined in China. So I'm spending a fair amount of my time these days trying to deal with miners that are willing to mine compliantly, not just for me, but other institutions that are really interested in owning a coin that have some kind of provenance to them. And so this is a new twist, and the only reason it's emerging is that the majority of institutions do not play in this asset class. I mean, it's exciting that some are coming in, but even at $1 trillion, it's tiny. If it's going to grow, it's going to be because it becomes compliant to ethics committees and sustainability committees. And so every miner I'm talking to now, because my strategy has been, as most people know that have owned Bitcoin, that you can tell the time of creation, but you cannot tell the location of creation. And if in fact you don't want to own China coin, or as now it's being called blood coin, which sounds a lot like blood diamonds, you're going to have to prove the provenance of where your coin was born, so to speak. And that means virgin coin, I think, over time, will take a premium over widely distributed or coins that you don't know the provenance, including ones held in ETFs. It could be a challenge. I believe ETFs will start to say these coins are known coins, mined in compliant countries, and these are not, or these coins are mined sustainably. So we've got a really interesting issue brewing here. I've been talking to miners. In fact, just before I came on here, I was on with another one, looking for capital, because they're finding out pretty quickly when they go to institutions to expand their operations, they're getting the compliance question I'm raising right now. How are you mining this? Are you using hydroelectricity? Are you burning coal? Where is the geography of your locations? How can you prove to us that what you're doing is compliant around what our standards are? Now, this is a whole new twist to this asset class, because the complexity of mining coin will only go up. And of course, you need a lot of processing power. Right now, the equipment is at a premium, margins at a premium. I've met manufacturers, if you want to call miners that have production costs as low as $5,500 USD, and others that are at $20,000. So it really determines on the volatility which of these is going to survive. But the amount of capital available for sustained mining is much higher. My strategy is simple. I'm going to partner with institutions, the ones that have come to me after talking about this. I'm going to buy positions in mines. I'm going to take a royalty off their production and know with certainty that my partners' coins are virgin and compliant. And I believe over time I will be paid a premium for those, and I'm not planning to trade them. To me, it's property. It's no different than real estate. You either believe in it or you don't. My current allocation is 3%.
I think Laura, I think this ESG issue is becoming a major issue for Bitcoin. There's a good Cambridge University study, though, that shows that 75% of miners use renewable energy, and of the total use of energy for authentication, or people call it mining, I call it authentication, just about under 40% of their energy comes from renewable sources. There's a public company called Riot Blockchain that uses only renewable energy, I believe, in New York State. So I think Kevin's identified an issue, and I think some people will use it to slow adoption. But I just wanted to point out those statistics. It's interesting, the standards that are applied to the Bitcoin and crypto world are not necessarily applied to other industries.
Yeah, I'll just add one more on the ESG front, because I know that Treasury Secretary Janet Yellen has focused on the environmental impact. So Yassine El-Mandra, our analyst, did a study and compared Bitcoin mining to gold mining, because Bitcoin's primary use right now is digital gold, and showed that the energy consumption associated with Bitcoin mining is a fraction of that for gold mining. And then when you broaden out the energy use by the entire financial services community, if DeFi, decentralized finance, is what we are talking about here, the energy consumption is, I think, a decimal point relative to that.
That every miner looking for capital is making right now, that the cost of maintaining fiat currencies is much more expensive. It is finding deaf ears on compliance committees and sustainability committees. I not know one that says, oh, that's okay then, let's just take a basket of coin that we don't know where it came from. This is going to be an issue. It's coming to a theater near you pretty soon. I don't know how it gets resolved, because clearly mining gold is a disaster environmentally. So you could compare those two, but when it comes to Bitcoin, somehow it's got itself tainted as a complete waste of electricity to some members of compliance committees, although I would argue that's not true. But definitely coin mined in China is tainted coin. And until there's a much broader understanding of what those miners are doing in terms of burning coal to create electricity, because they're not exactly transparent about what they're doing, there's going to be a difference. And the majority of coin being traded right now is in fact created in China. It's a speculation. I don't think it's wrong.
Well, it's great to have conversations like this to raise awareness to what people should be thinking about with this brand new asset class. I appreciate everybody's views on it. We're getting some other questions with regard to another investment strategy in terms of like what's referenced as psychedelic, or I had to highlight it here just because there's so many questions that are coming in. Anyone want to shout out on this particular sector?
I'm a big investor in this space. It's very controversial. As you know, these are Schedule I narcotics, psychedelics, MDMA, 18-MC, all these different molecules going into trials. The companies that are successful raising capital are the ones that are not offering any form of recreational drug at the outcome of their trials. They are going under the standard FDA protocol to develop these and prove them as medicines. MindMed is the one I've chosen simply because in mitigating my risk, they had the most trials with the most molecules. Junior pharma companies are a boneyard for investors. The outcomes are binary. You put up capital, you wait 7-8 years to find out if in fact the medicine makes it through trials. You don't know the outcome. It won't be any different for psychedelics, with the one exception that got me on board here was a CEO at MindMed, J.R. Rand, who basically walked me through his premise that there hasn't been a new drug for mental illness in 35 years. And as a result, we try and treat people by drugging them more in opioid addiction and anxiety and many other complexities. And there's a lot of promise that microdosing LSD and other drugs might solve for these problems with included therapies. That sounds like a pretty compelling argument to invest. And indeed, last year, MindMed was an 800% return for me. It's a public company. It's on the OTC, and the company has announced its intentions to list on NASDAQ. Who knows when that'll happen? But the bottom line is they have the most trials, the most molecules, and that's the way I believe you have to mitigate risk. But I warn investors, this is binary, 1-0. You don't know, so you have to allocate appropriately. Yet the outcome is so stratospherically fantastic. If they bring a medicine, it's worth taking some risk.
Yeah, I don't know if you want to keep going on this. We tend not to invest in binary, but we do think in the that there are incredible opportunities throughout the healthcare space because of the convergence of three technologies. One is DNA sequencing, two is artificial intelligence, and three is gene therapies, importantly, CRISPR-Cas9 gene editing. So we think that healthcare is going back into a golden age, the golden age that Genentech launched with monoclonal antibodies in the 80s, took returns up to north of 20% returns on R&D investment. Now that investment is down to 7%. We think this convergence of these three technologies, which from a cost point of view has only been possible recently, is going to create a new golden age in healthcare, which from our point of view could take returns north of 30%. So even better than what we saw in the 80s and 90s.
Thank you for your comments on this. Fascinating. I've learned a lot just in your two responses. That's helpful. Look forward to what's to come in a very positive way. Let's pivot to volatility and the recent trading patterns that we've been watching from afar or been involved in. There's been a lot of change in first of all access in terms of the apps that many new investors are utilizing, that utilize confetti to promote additional activity on the app and additional trading. Essentially the impact of social media, the strength and the reach of it, markets hitting all-time highs. I mean, the list is long as to potential reasons why we're seeing this volatility and recent trading platforms that patterns that are coming from retail and primarily. So, Jan, you've just launched an ETF buzz, which definitely caught a lot of attention, and I'm curious what your premise was behind the new Van Eck Vector Social Sentiment ETF.
Sure. Yes, I think really there's two things going on. One is that there are a lot of retail investors playing in the market. There were in January alone 6 million app downloads for trading apps, and the biggest ones were Robinhood and Coinbase. So clearly, individual investors are more engaged because of zero commissions and the crazy bull market of the last 12 months. But I think there's a separate trend entirely, which is that good investment ideas are not the monopoly of Wall Street. I think, Cathie do a shout out to Cathie because she's done a great job by sharing and being very open with the research that ARC produces. And so the concept of looking at all the messaging on investor platforms, whether it's StockTwits or Reddit or Twitter, and looking for signals and information in all those messages is really not a new one. It's been around for quite a while. The index that we track is also an index that's been a while. It uses natural language processing to take all those millions of messages and invest in large cap stocks. It's been around since 2015, and I think what we always look for when we launch a new ETF is a unique return profile, and this index we think captures not just momentum stocks, which one would think about with GameStop and everything like that, but also I'll call it contrarian plays. So in the fund and in today, there are some cruise lines, so some airlines. There's recovery plays as well. I'll call contrarian recovery plays, as well as sort of the big growth names of the FANGs and some of those other stocks.
Well, congratulations with your initial success on this. Kevin, Cathie, anything you'd like to add?
Well, I think what's going on right now has to do with the baby boom echo. There's an intergenerational wealth transfer taking place, and we do. As thank you, Jan, for the shout out here. We do give our research away. And we engage pretty intensively with our clients with webinars and, putting out our the top and bottom performers of the week and putting out our trades every day, disclosing our trades every day. The millennials and Gen Zs, to the extent they are experimenting here, they love learning. They're really excited about the new technologies that are evolving today. They're really at the leading edge of them and understand them and are comfortable with them. And I have been very gratified at the kind of response we've gotten to our research and the engagement, therefore, that we've gotten. I know that a lot of maybe regulators and people in the investment business are concerned that we're going to hurt the little guy here by allowing this kind of behavior. And sure, there's congressional testimony taking place, I think some this week. But I don't underestimate this group of people. They are actually more progressive. Jan mentioned this. Than I think institutional investors are, because the institutional investors over the last 20 years, tech and telecom bust, 0809 meltdown, have to face much more in the way of compliance. They have to jump through many more hoops if they want to stray very far from their indexes. And as you may know, I'm not crazy about the idea of indexes from an innovation point of view. It's kind of an oxymoron. Stocks and indexes are there because of their past success, and disruptive innovation is likely to disrupt the traditional world order. So I think that the heavily indexed or benchmark sensitive approach to investing is ripe for change. And I think that the retail investor, the individual investor, is actually leading the charge. Now, one other thing, just to focus on harm risk to the individual investor. These young people, and it's young and old people, anyone with a desire to understand how the way the world's going to work, they might speculate on Robinhood, but the beauty of what's going on is they're going to learn very quickly because losses impact psychology and sentiment much more than gains do. And so this period of risk off, risk on, I think is going to be very good in terms of teaching especially millennials, those who have not had any training in the financial world. It'll teach them quickly that there are risks. Sure, opportunities, that's been the last year. There are risks, and you can lose a lot of money if you take too many risks. So I think they'll learn quickly, and I'm not as worried about that as others are.
I just wanted to add something about Robinhood, that because most people that have criticized it, particularly on the Hill, have actually never used it. I decided to join the Wall Street Bets crowd. I became a member of the whole Reddit, call it the herd, if you will. I downloaded Robinhood. I put $10,000 into it. I called the CEO up. I had no idea if Vlad would call me back. He did. And the night before he went to Congress, I wanted to offer him encouragement. I think he's done something very innovative and educational. He's the number one app being downloaded, or at least he was during that period on the Apple Store. It's got over 20 million accounts. But here's a fact that a lot of people I don't think understand. You cannot short stocks on Robinhood. There are many OTC stocks you can't trade. He's an engineer. He's a pragmatic guy. And I'll speak, I think, words of support, because he's trying to stop young people who are using the platform to learn, even though it's been gamified, that's true, from blowing themselves up. You can't use excessive margin. You can't short stocks on margin. There's so many things that are very educational. As a young trader, I learned pretty damn fast that you can really hurt yourself when you start to use tools you don't understand the power of. And he's removed that from the platform. I'd add one other thing that is changing institutional behavior. If you're in the business, and these are usually hedge funds, 2 and 20 mandates that go into the Russell 2000 and short stocks that are very thinly traded with heavy short floats, you have new risk because the data information is less expensive and more accessible than ever before. And what I learned about the Reddit crew, they're not as dumb as everybody thinks. There's a lot of people there that understand that a very small amount of capital on the right situation can cause a tremendous pain for shorts. So they now have a new risk in their models. And I think it's going to be very difficult because that herd is riding every night, communicating sometimes hundreds of thousands of times, finding their next target and squeezing out those shorts like a teenage pimple. And for some of them, they're going to make money, but it's a whole new risk for the old traditional hedge model.
Well, what's funny, Kevin, is I think the hedge funds are on Reddit. Smart guys like you are on these platforms too. So it's not one camp over here and the other camp over there. I will say, though, there is a very legitimate concern about market manipulation. And I think that's why platforms like Robinhood or Fidelity, the one I use, limits your trading with smaller cap stocks. And the ETF that we've launched only invests in large cap stocks with $5 billion or more market cap. So that's something I wanted to note as well, that there is some bad behavior out there.
And it's important that the SROs and regulators monitor for that, of course, which is something that we take very seriously as an exchange. We are coming up on the last 15 minutes of our discussion. I have one more question, kind of a broader question I'd like to ask. Would love your views on, essentially, as we begin to approach what we hope could be the post-pandemic world, there's no doubt we're not going back into the same normal. We are going into the new normal, like you had mentioned in your earlier comments. And there's been many innovations and much change brought about that's going to be here to stay, like the forum we're in right now. So just if you could expand a little bit more on what industries, what trends, what markets will evolve as winners. Kevin, you already pointed to a few losers, which I certainly agree with. But what's your key takeaway for investors?
I would suggest that the new economy emerging, I like to call it America 2.0, has gone through a massive digital pivot. The successful companies are ones that are going to sell direct to their consumers on an ever-increasing basis, using the technologies that were made available and then tested during the pandemic. And I would argue at the large cap, just look at Nike's numbers. They've achieved something in 5 months that they thought would take 6 years. They're almost at 50% of their global sales direct to consumer, much less reliance now on the old retail model, which is very inefficient. Plus, they're getting tremendous amount of data about their customers' wants, needs, desires, style, all that, and when they buy and for what price points they buy, et cetera. And that mining of customer data, by the way, is not the purvey of large cap anymore. It's inexpensive, it's cloud-based. I have companies doing 50, 100 million that we're investors in that are using the same technology in all kinds of different sectors, everything from commercial kitchens to gym equipment manufacturing, greeting card companies, a wide range, insecticide manufacturers that have figured out a way to sell direct to consumers. And the stocks that are powering that are not just domestic. I mean, one of the indexes that O-Shares developed was Global Internet Giants, and we simply used the technology to go and mine data from companies' balance sheets and income statements. We simply asked the question, who's growing quarter to quarter in revenue and who's profitable, so their balance sheets every quarter get more and more powerful in terms of quality. And as a result, if you'd done that indexing 20 years ago, 95% of the companies you'd find in it would be US based. Today, it's only 60%. There are many, many companies people never heard of that are growing way faster than the FANGs all over the world and have become giant multi-billion-dollar behemoths. And those are the ones that we caught in our net when we indexed. that index was up over 100% last year. And they're not stay-at-home stocks. They're work-from-anywhere stocks. So I would argue the new economy is going to be using technology more than ever, including the S&P 500 companies. They're going to be cutting costs like business travel. They're going to be cutting their footprint in commercial real estate and in corporate offices. It's all going to go to the bottom line. And the losers are some of the sectors that have been winners for the last 30 years. I mentioned airlines, but I also think REITs that are heavily involved in B-grade malls in America, that's going to be a tough one. Movie theater, Cineplex chains, all of those kinds of things, they're going to have to be turned into cloud kitchens or whatever. But there's a massive change going on in America, and you have to be nimble to catch it. Because if you just index, you're going to have some problems.
I'll just jump in here. I just think, our firm, I don't know who on this call knows, but my father kind of made his name in the mutual fund industry because he took an international stock fund and moved to 80% gold shares in the late 1960s, anticipating an inflationary burst in the 70s, which ended up happening. Which most people don't know is that gold at the time was pegged at $35 an ounce, and it had been pegged to the dollar for the basically entirety of U.S. history, so the prior 200 years. And so my mindset, our firm's mindset is the future can be really different than you might imagine it. And not just from a technology perspective, but from other perspectives. So I don't know what it will be, but I do say that there is a scenario now where you have GDP growth of 6, 7, 8, 9%. I just do not think it's priced into the market right now with long-term interest rates potentially going higher. So I agree with what Kevin said about owning equities. I would just keep some cash ready for that kind of a scenario. And just to say, my favorite fund or ETF that we have right now is our Wide Moat ETF with the ticker symbol MOAT, which does use some forward-looking human-based research, and it's a core strategy, large cap strategy, but it does pivot between different sectors and different exposures. And it has a little bit more of a value tilt right now. So I guess that would be my favorite ETF of 2021 of the ones that we offer.
Great. Cathie?
Sure. Well, all we do is disruptive innovation. So I'm talking my book here, so consider the source. But innovation does solve problems, and the coronavirus crisis created so many problems that thankfully our companies were able to pounce on and help solve. So we believe that over the next 5 to 10 years, we will see more innovation than we ever have in history. You have to go back to the early 1900s, telephone, electricity, automobile, to get even a sense of what's about to happen here. We have 5 major innovation platforms involving 14 different technologies that include DNA sequencing, robotics, especially collaborative robots, energy storage, artificial intelligence, blockchain technology. And as I said, 14 technologies involved in these 5 platforms. What's really interesting, and I think not well understood by the marketplace, is that these platforms and technologies are converging. Technology is permeating every sector, every industry. And I think research departments in our industry are going to have to flip themselves on their heads. Right now, they're very specialized, very siloed, very short-term in their orientation. Our analysts are broken out by platform. So they're specialists in technologically enabled innovation platforms, and they're generalists when it comes to sectors. So I think the world is, as Jan said, going to look very different. And when you have 5 major platforms converging, the kind of disruption you're going to see is one S-curve feeding another is pretty explosive. In fact, I've tried to ask people, how do we describe the magnitude of what is about to happen? And some people use combinatorial and other mathematical ways of describing it. But I had a very simple explanation when someone heard what we were talking about. Think of waves, powerful waves in a storm, interacting with one another. Some ships will rise, some ships will fall. But the amount of energy, explosive energy coming out of this ecosystem is going to change the world as we know it. So, as Kevin said, we completely agree. The traditional world order, and Jan would agree with this as well, of course, the traditional world order is going to change. Beware, value, yes, there are some great value stocks out there, but a lot of value stocks are in harm's way. We believe that more than 50% of the S&P 500 is going to be impacted dramatically by all of these changes.
Well, Cathie, the model that you described certainly has proved successful thus far. So I love your analogy. I love your analogy about the waves crashing, because I could just feel it, as you describe it, and appreciate that. So we've come to the end of the did you want to jump in once, please?
I think it's going to feel very confusing in the years ahead, because you've got these deflationary forces I described in the beginning, juxtaposed against monetary policies which seem unhinged. So there's this huge debate. I think deflation wins. And then again, this idea of all of these technologies causing booms in part of the economy, but depressions in other parts of the economy. So again, lots of confusion, great time to be an active manager.
For sure. Well, I could just continue this conversation on for another hour, but we're actually at the top of the hour right now. I can't tell you how much I appreciate your participation, Kevin, Cathie, Jan. This has been a lot of fun. I'd like to also thank all of our viewers who have signed in. And if you are looking for an on-demand version of this, it will be coming your way in your inbox, so you can easily click on that link in the future. Once again, this is just terrific. Signing off now from Cboe's Exchange Perspectives. Have a great rest of your day. You've certainly made mine.
Thank you.